Welcome back to another episode of Retired Right. I am Ryan Wyatt. Today I'm joined again by Ron Wyatt and Nick Lewandowski. I think I'll come up with some nicknames that are relevant to the topic that we're going to cover today, and I think it's going to be a little bit of a different approach that we're going to use. So the topic that we are going to cover, I'm sure a lot of people have been hearing this on the news, is tariffs. So today, Ron is going to be Mr. Pro-Tariffs, and Nick is going to be Mr. No Tariffs.
Tariff man, and
I forgot my Trump hat, but hey.
neoliberal scum.
So, just what we're doing is, I'm per usual. I'm going to moderate and I'm going to kind of guide the discussion, but we just want to really talk about a high-level overview of what tariffs are. Are they good? Are they bad? Why the government would implement a tariff strategy, and we're going to talk about like both sides of the kind of argument there. Anything you guys want to add before we jump in?
Yeah, something really important, because I'm the primary owner of the company, Nick. I get the win.
And I think it's important to say that, like, we are all friends here. We're just trying to make it a fun discussion.
All friends.
Usually we're all friends.
Usually we're all friends.
All friends, and I would say that purposely we're on complete opposite ends of you guys are on opposite ends of the argument, strictly for the podcast.
We don't necessarily
completely
disagree with each other.
This is more educational in nature.
Yeah.
It's just a fun way of doing it.
Yeah, exactly. So, per usual, let's just start as high level as we can. What are tariffs? Kind of like, why would they be used?
You want to take that?
I'll start with the negative connotation out of the gate. A tariff is just a fee or a tax, to call it, to frame it more negatively, that are applied to either, usually it's goods that are coming in. Usually it's imports that are coming in. They could be applied to exports as well.
Okay.
That's fair.
Got it. Good, bad, tariffs good, bad, both.
Go ahead, tariff man. I cede the floor to you.
So I think they're good for a couple reasons. So, for example, let's just say that we're trying to sell cars to Europe, and they put a tariff on our cars. It's going to be difficult for our cars to be competitive, so it's only fair to tax their cars coming in to level the playing field. That's one thing. The other thing is, let's just say that China is producing goods that we're buying, and they're doing it at a loss, so the government has to subsidize. What happens is that sounds good. We get cheap products, but what happens is that what happens if all of our cars we buy from China and all the steel we buy by China, all of a sudden we don't have any heavy industry. So how can people buy anything when they don't have a job?
Got it.
Okay.
So,
and then lastly, defense. Like, if we don't have these important industries, then for national security, what do we do?
Okay. So the pro-tariff side of the argument would be it's going to kind of force the United States to rely more on the United States.
Yeah.
We're going to be producing more internally. People are going to be less incentivized to buy goods that are shipped in from other countries, like, Japanese-made cars, for example. Is that a fair kind of like summary?
Absolutely.
Okay.
And it's also a way of raising taxes for to help pay off the debt.
Do you want to cover that piece now, or do you want to get to that
after
Nick
I'll give Nick a chance here.
So on the negative side, the problem with tariffs is they make everything more expensive. If we can import goods more cheaply, whether they're finished consumer goods or whether they're inputs that go into other industries like raw steel, well then our companies that are using those raw materials and our consumers can get those goods at cheaper prices, which should help ease inflation, which has been a big thing in the last few years. And it should also, I would think it would help economic growth by basically decreasing costs and freeing up cash to be reinvested or to be spent on consumption elsewhere.
Got it. So I know, towards the end of the Biden administration, they were talking a lot about different ways that they could ease inflation. And I think what you're saying is kind of like hinting at, hey, tariffs could actually be inflationary. It could pick up inflation. So
Sure,
because if Trump does kind of like implement this tariff strategy he's talking about, do you think that that means inflation is going to be higher for some time to come?
The anti-tariff camp would say absolutely.
Okay.
That if you are basically allowing foreign governments, even if they're cheating, as my colleague was kind of saying, but they're cheating because basically foreign governments are willing to subsidize that production and they're willing to push out goods and raw materials at lower costs, let them bear the cost of it as opposed to our consumer. If you take away that subsidy by neutralizing it with an additional cost, of course, it stands to reason that goods will be more expensive.
Got it.
Now, I do want to do a quick aside. That was kind of me in character. I want to do a quick aside in that in reality it becomes complicated in terms of, maybe, Ron, you can talk
See, I
about
think
that
what
for a
happens is he's
second.
leaning to my side of the
Yeah, right, exactly. I realize my position is
because I never would give into my position.
Yeah,
But
you know,
I'm sorry, go ahead.
Ron won. We'll just wrap up.
Yeah, the competition's over. No, but I want to be intellectually honest in that when you get into how things are actually implemented, like companies in reality will tend to adjust. So some price increases may not end up fully passed to the consumer. Sometimes supply chains can be rejigged from tariff countries to non-tariff countries, and that eases it up a little bit. There's all these different things that will happen that make it actually kind of hard to predict. I'm kind of arguing from the Econ 101 textbook.
Got it. Okay.
And I want to add one more thing. I think the reason why Trump's also he's using tariffs as a tool, with politics. If you don't force the issue, nothing ever gets done. And I think he has certain agenda items that certain things he's trying to accomplish, and he's using tariffs as a tool to get them done more quickly.
Can you give one example?
Like with Mexico and border safety, right, and drugs. I mean, so put a tariff on Mexico, and then they send a bunch of people to the border to help secure the border, and they start cracking down on fentanyl. I mean, so that's...
Yeah, what didn't Mexico actually like help us at the border with kind of policing it?
Right, after Trump put the tariffs on, there's
And
a 30-day delay.
And then he pushed back the start date on when the tariffs would take place because they were cooperating, essentially.
Yeah, they're negotiating now, right?
No, okay,
yeah,
got it.
But that's an example of Trump said, hey, if you don't do these things, then they're
Then this
legitimate
is what
requests,
yeah.
then this is what's going to happen. So then he gave him a 30-day reprieve, and now they'll work on,
Understood.
what the resolution looks like.
Got it. So Ron, you mentioned something earlier, which I'm really curious about, that you said something about a tax structure, or it's a new way of taxing. Could you expand on that?
If you look years and years ago, and I don't know if it's 100 years ago or 200 years ago, but the United States used to not have a tax on income. It used to be the tax was primary tariffs. Mm-hmm. And it seems like Trump's going back that way a little bit.
Okay, got it. Is there anything else that either one of you would want to add on like the tax piece specifically?
One thing that, again, I'm breaking character again here, but one thing that makes it complicated when it's like, what's the impact on economic growth? And Ron and I were talking about this before we started recording, is that, even if you impose tariffs and they hurt growth a little bit, and they're a little bit inflationary, if that's being offset by big tax cuts, which is one of the things that gets put out there as wanting to be done, does that have an opposite impact that helps mitigate the impact? It's very possible. We have to see, but so it gets complicated.
So is this round 1 or 2 so far? So I think so far. God, I'm sorry. I think so far I'm winning.
So I appreciate it. I think that's like a really good high-level overview of just kind of everything that you would want to know about tariffs. So let's talk about its impact on the market. So, Trump took office recently. He's talking about implementing tariffs on Canada, Mexico, not sure what other countries, but how have the equity markets been reacting to that news?
The markets agree with me and disagree with Ron. They say bad, down, red numbers.
I don't know. The markets have been pretty flat, so I think it's kind of wait and see.
On the announcement day, they were down.
I'm saying since Trump took office to now, okay, the markets haven't moved that much. I think they're slightly positive.
Okay.
And people knew that Trump was going to they knew that Trump was going to be using tariffs as a tool.
Got it. Yeah, because he wasn't quiet about doing that when he was campaigning.
Right. But I think where Nick and I would agree is that it's kind of wait and see. We don't quite know yet.
So has there been maybe like more volatility recently because of the unknowns?
I would say, in all seriousness, all joking and fun aside, on a serious note, I think sometimes when announcements are made, there is on a daily basis some more volatility. And I think it's important for the audience to know that, like Ron was saying and you were saying, everyone knew once Trump was elected that tariffs were going to be a thing in some form or fashion. So the market prices ahead.
Right.
So some of that's already priced. And so when these new announcements and changes come out, when on the day when it's announced, people try and quickly digest that. And if they think it's like worse than expected, things will go down that are affected. And if it's better than expected, things that are affected will go up more than expected.
So the thing I guess that I find interesting or that I'm curious about is, like, I know just through having conversations with Ron, especially about this, he says all the time, like, the market, like what you see in the market today was really priced like 6 months ago. Right. You're just seeing it now. And so
another way of looking at it is the market's thinking ahead.
The market's thinking forward 6 months to a year. So do you, like, basing that on this tariff discussion, did the market potentially factor that in when Trump was campaigning that, hey, there might be tariffs? Or did it not really have a chance to because it didn't know who's going to win the election, and now it has to react to it, and it's kind of in this lull? Like, could you just maybe break that down?
So the market anticipated tariffs like Nick said and I said earlier, right? So as Nick was just explaining, anytime there's news, positive or negative, it for a day or a week or whatever, it can affect certain sectors in the stock market. But so far, the market as a whole hasn't been that volatile. It's just been certain sectors, certain companies, right? So just too soon to really know. But so it's priced in what it knows. It's what it doesn't know. The new news is what's affecting the market.
I'll let you guys take a break from being on different sides of the table. Do you think that the recent volatility in tech, or that the sell-off that happened not too long ago, do you think that was in any way linked to the tariffs?
So I think it's linked in a roundabout way. The biggest variable that people debate how tariffs are going to impact is how does this show up in the inflation numbers? And we did another podcast where we talked about the relationship between inflation and interest rates.
Yeah.
And so when, if it seems like the market's leaning on the side of tariffs higher, inflation higher, interest rates higher for longer, that tends to be bad for things that are hurt by high interest rates, right? And vice versa. So that's what you see sometimes with these moves.
And are you saying that tech companies specifically are hurt by high interest rates, or am I not?
Go ahead, Ron.
So, I mean, it's funny that the large, very profitable tech companies can handle higher interest rates because they don't need as much debt because they're very cash flow positive.
Right.
They have good balance
sheets.
And
they don't have inventory, large inventories where they're right.
And so they're profitable. They're don't have a lot of debt, so they don't have to worry about the interest payments. Where small companies tend to financially not be as solid, and so it can affect small companies more. That's what's been happening a little bit. But the other thing that's happened to tech with the volatility isn't really anything to do with tariffs. It has to do with Chinese and AI, and they seem to have a more efficient way of teaching, helping the AI learn.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Okay, so then what about bond markets? How have the bond markets been reacting to the news? And if, I would say, if an aggressive tariff strategy is implemented, what do you think that means for the bond markets?
So I think with the bond markets, so I would say overall, there's been just up and down, like we talked about with the equity markets, because the same pricing thing is happening in the bond markets. I would say that if on the bond side of the equation, if tariffs are put in very aggressively, and if it does translate to higher inflation, and if that means that interest rates stay higher or go up, that would be a short-term negative for the bond markets price-wise. But we always have to remember that when rates go up, over time, you will have more income coming in as well. And over some period of time, that effect offsets.
Right. Okay. So
by the way, he just made my point, which is that it's rates will go up, which could put a little pressure on the market, but long term, it adjusts, right? It's
you're saying the bond market or the stock market adjusts?
Well, both. Once it gets in the system and people get used to how to navigate through it, then things settle down.
Right. Yeah. So Nick, what you're saying with bond markets is that basically if it leads to a higher inflationary environment, well then interest rates would remain high, essentially.
Yeah, and you've seen kind of Jay Powell, the chairman of the Federal Reserve, had a big hearing just the other day, and they were really before Congress, and they were really questioning him and trying to get him to make directional comments about interest rates and growth and all these things we're talking about. And he was very middle of the fairway in his remarks, just kind of saying it's something we're going to continue to watch, and what the data indicates that we need to adjust, we're going to adjust.
He was very weak.
He was very weak. That tariff man says he was very weak.
I knew we made a good hire when we brought Nick in. In his free time, he's watching Jay Powell. I'm watching a new show on Apple TV.
So I don't know if that actually answered your question or not.
It does, yeah.
Something that you said in your question made me think of bringing up Jay Powell's remarks.
I had to throw a little joke in there. All right, then let's bring this. The final question I have was, and I don't know if you guys are going to need to take the opposite sides of the kind of table here, but thinking about the all-season framework. So we talk all the time how that's really built, whether economic growth is high or low, inflation's high or low, it's really meant to kind of provide the best risk-adjusted returns throughout either environment that we're in. You're diversifying assets across all of those different, economic cycles or whatever you want to call it. We've never really talked about tariffs in that. So assuming an aggressive strategy is implemented, how does the all-season framework tie into that?
So if you look at, I don't care if it was like the tech bubble, the global financial crisis, tariffs, COVID. At the end of the day, four things can happen. That is, the economy can accelerate or decelerate, right? You can get into a recession or expansion, and inflation can go higher or lower.
Right.
That's it. We don't have a crystal ball about what the tariffs, what it will mean for the stock and bond markets, okay? On one hand, you could say, hey, this should help bonds. On the other hand, you could say it can hurt them, right? So the way we do the framework is we don't need to have that crystal ball. We do it in such a way that we have some assets that if the economy is strong or weak, inflation's high or low, that will react well in those environments. Right?
Got it.
So what it does is it makes the return more consistent.
Right. So I guess what you're saying, like from a portfolio management standpoint, you're not this isn't very concerning to you because at the end of the day, it's, you think tariffs, right? And then if tariffs are implemented or they're not, that's going to impact the economy positively or negatively.
Right.
It's going to impact inflation positively or negatively. We know what assets do well in those types of environments. And because we don't have to have that crystal ball, or you just can't. You can't predict the future. We're structured in a way where we're diversified across those different scenarios, so it's not really worrisome to us.
Exactly. So let me
I did have one.
Go ahead. There was one more thing I wanted to add.
And I have one more final question too.
Okay, so let me just give an example. So let's just say that tariffs initially cause a little inflation, but then all of a sudden it causes a recession, okay? So let's just say that economy gets weak, and inflation goes down, right? Because it causes a massive recession. We have treasury bonds. In that environment, treasury bonds tend to do really well. On the other hand, let's just say that it actually, these tax cuts help. Yeah, so there's a little negative with tariffs, but the tax cuts more than offset it, and we're off to the races, right? So investments like private debt that have floating rates, you're not so concerned about credit risk. That's the risk of default because the economy is strong And if interest rates happen to go up a little bit, because it's floating rate, you'd end up getting paid more, as rates go up. So again, that's where we're trying to position the portfolio. So whatever happens, more consistency in returns.
Okay.
And the thing that I wanted to add was just that the historical asset class performance data that all of what Ron's explaining about the strategy is based on, and why he built it this way. We've seen over that data history periods where globally, conditions have been more restrictive for trade and more open for trade. So we can be very confident that these relationships between asset classes aren't unique to the last 20 years, and that's all going to be upended by trade policy.
I'm going to geek out a little bit here. So we use this service called Nitrogen. And what they do is they profile our clients for risk tolerance, and they also can show the risk of a portfolio. And if you dig into Nitrogen, they can also give you a grade point average. And 4.3 is the highest. I think 4.3 is the highest, right?
It is.
Yeah.
Yes.
And I don't know how low it goes.
0.
But
no. I don't
but our balanced portfolio has a ranking of 4.3. This is something that we had designed before using Nitrogen. So it's not like we use Nitrogen to do it. We use the framework, and the framework, according to Nitrogen, has huge diversification benefits.
Okay. So let me leave it with this. Instead of me closing it out, I'll ask a question, and we can just let this be kind of like the closing statement. So if somebody is worried about tariffs and its impact on their portfolio, and they're not using some sort of all-season framework, what would you tell them that they should do?
Run for the hills. No, I'm not kidding.
You need to email Ryan Wyatt at wisewealthadvisors.com and schedule a call to see how we can apply the all-season framework to your portfolio.
See, I agree with Nick there, so we're good. Hey, Nick, we ended this on friendly terms. That's good.
No, but what I will say is that I think a lot of our clients find peace of mind knowing that irregardless of what inflation's doing or the economy's doing, we're diversified to kind of spread the risk and participate in the growth, try to minimize some of the downsides through that approach. So if you are worried about how your portfolio is set up and how it would handle, if inflation's higher, interest rates are higher, et cetera, just go to our website. You can book a 20-minute introductory call. We can see if there's a good fit, and then we can do kind of like an in-depth analysis from there. Hope you found the episode enjoyable. Website's wisewealthadvisors.com. That's WYZE wealthadvisors.com. Thanks.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.